The iShares Core U.S. Aggregate Bond ETF, ticker AGG, is one of the most widely used bond ETFs in the market and serves as a foundational building block for many diversified portfolios. If you've ever heard someone refer to the bond market in broad terms, AGG is often the ETF they are talking about. AGG is designed to track a market value-weighted index of U.S. investment-grade bonds. That includes U.S. Treasuries, government agency bonds, mortgage-backed securities, asset-backed securities, and investment-grade corporate bonds. Together, these components represent the core of the U.S. fixed income market. What makes AGG especially useful is its breadth. Instead of trying to pick individual bonds or sectors, AGG provides exposure across thousands of bonds in a single ETF. This diversification helps reduce the impact of any single issuer or bond type on overall performance. One important thing to understand about bond ETFs like AGG is how they are managed. The underlying index contains far more bonds than any ETF could realistically hold. To solve this, AGG uses an optimization strategy. Rather than owning every bond in the index, the fund holds a representative sample designed to closely match the risk, duration, credit quality, and return characteristics of the broader market. This approach is common and necessary in bond ETFs, and AGG has historically executed it with a high level of precision. From a cost perspective, AGG is very competitive. In a segment where several ETFs track nearly identical benchmarks, costs and liquidity become the main differentiators. AGG's expense ratio is low, and its trading costs are among the most predictable in the category. The fund has massive daily trading volume and consistently tight bid-ask spreads, which matters both for long-term investors and for those who rebalance more frequently. Performance-wise, AGG does what it is designed to do. It closely tracks the returns of the broad U.S. investment-grade bond market without surprises. Investors are not buying AGG to outperform dramatically, but rather to gain steady, diversified bond exposure with consistency and transparency. AGG often plays a central role in portfolio construction. In traditional stock and bond portfolios, it is commonly used as the core fixed income allocation. For example, an investor following a 60-40 portfolio might hold 60% in equities and 40% in AGG. Others use AGG alongside shorter duration or inflation-protected bond ETFs to fine-tune interest rate risk. It is also important to understand how AGG behaves in different environments. Because it holds a large allocation to Treasuries and agency securities, AGG tends to provide stability during equity market stress. However, it is still sensitive to interest rate movements. When rates rise sharply, bond prices fall, and AGG will reflect that. This makes it a diversifier, but not a risk-free asset. If you're finding this breakdown helpful, make sure to like the video and subscribe to the channel. We break down ETFs like this one by one, so you know exactly what you own. AGG may be appropriate for investors seeking income, diversification, or reduced volatility relative to equities. However, it is not designed to deliver high returns, and it should be viewed as a stabilizing component rather than a growth engine. The key takeaway is that AGG provides reliable, low-cost access to the core U.S. investment-grade bond market. Its size, liquidity, and consistency have made it a default choice for many advisors and institutional investors when they want broad bond exposure without complexity. Before adding AGG or any bond ETF to a portfolio, investors should consider interest rate risk, time horizon, and how fixed income fits into their overall strategy. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial professional before making any investment decisions.